Now, Mihir Vora is with us, Chief Investment Officer at Trust Mutual Fund. Mihir, great to have you with us here. Thank you for your time. So, I guess first question is IT. What else? What do you think? Earnings impact, as we've heard from company after company and exchange releases, etc., seems to be minimal. But when uncertainty goes up, not just what's happened, but what may happen in the future, caps valuation multiples, doesn't it?
Yes, it does. And in any case, we've seen that the large cap ITs were not the fastest growing parts of the market in any case. So this certainly does not help sentiment. We have seen that there is some differentiation between companies which have less of H1B dependence versus companies which have a little more. But I think it's really, markets today reacting to the initial news. But in any case, if I were to take a 1 to 5 year call, then given the current business models, the large cap IT companies especially don't seem to be the fastest growing parts of the economy. I'd rather stay with the domestic themes.
So don't buy, even if you have a 2, 3, 5 year kind of horizon. Don't buy IT.
Absolutely, because the domestic and the segments in which the government is focusing on, like investments, consumption, etc., have a tailwind for them. Whereas in IT, you're only going to see incremental headwind. So while the US has clarified that the H1B program and the fees will not be on a retrospective basis, it does not apply to the existing stock of holders. But incrementally, obviously, it's going to be more expensive, and at $100,000, I think the H1B program pretty much becomes very, very selective and unviable for the normal kind of IT services that we were used to. Specialist roles, etc., will continue to happen, but that'll be a very minuscule portion. So obviously, the IT sector will face headwinds in its current business models unless they do things differently.
Well, indeed. Hi, Mihir. Good morning, and good to see you, Ben. Tech seems to be going through its own share of problems. For the time being, though, there is some kind of recovery that we're seeing from the low point of the day, so we'll see how that one goes. Let's focus on the domestic themes then. Trump seems to have stole the thunder away from the GST 2.0. Let's talk about that. GST 2.0 goes into effect from today, and we could be bracing for the best possible consumption period. Possibly. The next 30 to 45 days could see a lot of buying. At least that's the hope. Consumption-related names as well as on autos. How much of this good news is in the price, and how would you approach these sectors?
Absolutely. The PM himself has said, go forth and buy stuff. So obviously, that's going to create a good tailwind for the discretionary consumption segment. I think not only goods, but also services like airlines and hotels, etc. We are in for good times. And the fact that companies have done proactively a lot of pricing adjustments to at least create that buzz around the whole GST cut. So the timing was appropriate. We have the Navratri season and the festive season now starting for the next few months. So it should be good times for consumption. I think the sector has been quite under-owned for quite some time. So while stocks have reacted and have gone up in the last 1 month or so, I think if you look at the portfolios of a lot of mutual funds and investors, there was a lot of underinvestment in the sector. So you might still see a lot of incremental money flowing into this segment.
Okay, all right. Mihir, what about, market construct itself? We have had our own set of headwinds, particularly in the last 12 months or so. Same time last year, the markets were extremely buoyant. Earnings growth was expected to pick up. We're talking about, even scaling higher from where we were at. Last 1 year, no returns. That's why retail is getting a little bit frustrated, because they're not used to this sort of a period after 4 very, very good years. So now the maturity of the investor will come into play. What is your approach with regard to the index? We are still holding strong, given the headwinds, whether it was geopolitical issues, whether it was with the lack of earnings growth, and the entire Trump saga that's played out. Do you think the markets can hold their own? The recent lows will be protected, the lows of this year, and the markets maybe see a time correction?
Well, we've already seen a time correction. As you mentioned that we've not made returns at the index level in the last 1 year. But the big issue is that we have to probably select which index we want to look at. Because we were just talking about IT. That's the second largest segment in the Nifty 50. And the largest, of course, is banks and financials. In IT, there are headwinds as we just discussed. In banking, while everything is hunky-dory, valuations are cheap, we are still not seeing credit growth, which the hope is that it will happen for the second half. So IT, I'm not expecting to do much in the next 1 year or so. But banking, a lot depends on banking and the consumer part of the segment, apart from the traditional ones like government consumption, government investments, defense, etc., to drive the index. The good thing is that it was very lopsided for the last many years in favor of financials and banking as far as index returns are concerned. Now we'll have to depend a lot more on the other segments for the index to work. So it's going to be, my guess is it's going to be a year in which stock picking will be more important than looking at the index levels.
Mihir, let's focus on the metals pack then. There is hope that there can be a recovery from here on. The stocks, actually, to be fair, they have been the outperformers in the last 30 to 45 days because there is hope that China is getting its act together. There's going to be a lower amount of supply coming out of there, and we're bracing for some price increases in all probability post the monsoon. It's a tricky sector, but I've seen you in your earlier avatar as well. Sometimes you don't want to play the core metal plays. You look at some pipe makers. You look at other ways of playing the metal theme. How would you approach this space? Because clearly the government's measures, Chinese measures, and the Fed rate cuts, bode well for base metal prices. So your approach?
Base metals for me is always a tactical trade. So even if prices move up in the short term, they don't last, frankly speaking. In metals, the plays are more on the precious metals side, where unfortunately we don't have a lot of stocks to play with. It's mostly the ETFs which have direct exposure to commodity that we can play. But metals like steel, I would say, are more of a tactical play. There might be a structural rally in things like copper, but again, we don't have a real pure play, copper play in the country. So while you might want to take a view on some of the metal stocks, it'll be more tactical, and in the metals like gold, silver, copper itself that matter, we don't really have a direct play on the underlying.
And what about the pipe makers and the likes? Would you look at that? Because, construction could pick up. So some of these pipe makers which have made no money whatsoever. There are the other suppliers with regard to the oil and gas space. Water could be in a bit of a headwind because we've heard about collection issues. But the hope is second half of the year will be better. So anything you like from that pack?
Absolutely. So the pipe makers have done well or expected to do well, irrespective of the metal prices. Though I wouldn't really play them for the metal price. But the fact is that given the buzz that we are seeing in construction activity and the continuing of government spending, etc., pipes in general should continue to do well, especially the ones which are more linked to real estate, because we do see that real estate construction in urban as well as in the rural areas should continue to do well.
Yeah, no, absolutely. And I think that's an important point.
And the other big one, and on the in pipes, the other big segment is, of course, in the structurals, which is linked to the government spending on infrastructure like your buildings, your airports, your railways, etc. Where again, I think given the state of the economy, the government is unlikely to let up on the spending on the infra part also. So I think the structural pipes, as well as the pipes used in your water for residential purposes, etc., should continue to do well.
No, those are important points. By the way, the market has recovered, right? The market is down only 40 points now, and it's come off nicely. The low today is 25,200, and we are at about 25,290 nearly. So that's the lift that the index has got. And the IT index is also recovered. It was down about almost 4% at one point. The low is 35,145, and we're at about 35,600. So, it's down 2.6% at this point in time. So coming up very, very nicely at this stage. Urban companies now up to 196. So about a 6% pop now on Urban Company. Any thoughts here? Mihir, Urban Company, did you participate in the anchor round or later since listing?
Well, I won't comment on individual stocks, but as of now, we don't have any holding in that particular name, and I would refrain from making a comment on the stock.
You like the business? Do you like the business, Mihir?
So in general, we like the scalable businesses, where the TAM is large, So you have some of the other ones. We have some of the other ones in good measure, like the delivery services, like some of the online ticketing services, online auction places, etc. So in general, we like the network effect kind of a space per se, and we have a good exposure to this segment, the new age B2B and B2C companies. Yes.
Okay, thank you very much, Mihir, for joining in. Look forward to the next conversation.